So today's Cardinal Lesson, the financial asset classes for retirement income. I mean, when you're at retirement, when you're close to it and you're planning for it, all the time leading up to that, you've been looking at your assets and you've just been getting your income from your job and your work. And now when you're retired, you're going to have your Social Security check, or maybe you're even going to delay that, and you're going to need an income to live off of. And so, when people come into us, they generally have their money spread out in these 7 categories or asset classes. And a lot of them have a disproportionate amount of it in their IRA. I mean, we have a lot of them, it's as much as 90% of their financial wealth is in an IRA pre-tax. And that's a problem, okay? When you start pulling out income and you view it as a savings account, and so maybe you're going to make some big purchase or something, you're going to have a huge tax problem when you go to get money out of that. So people come to us and they've got their money distributed, and it's wherever it ended up. I mean, it's just, they had a plan and they focused. I mean, some people have a lot of cash. Maybe they got out of the market, maybe they sold their house, or they sold some asset, or they sold a business. And so people come to us with a lot of cash. And, maybe they have cash and they have 401k and they don't have much else. And so we've got to put together a tax plan and an income plan for them to live off of. So a lot of our work that we do for people is redistributing the money, is taking money out of the 401k and just pulling it out systematically and living off of it. Some people decide to take a chunk of it, leave it in an IRA, but move it over to an IRA annuity that's going to send them a check every month for as long as they live. So a lot of our financial planning, the result of it at the end when we're making the recommendations, is just moving money around from box to box. So I want to put it to Tom, and I want Tom to share with you why we're doing this video.
Yeah, I mean, we're doing this video because a lot of our clients, and this might be you, have been great savers, right? They've spent their whole lives saving money, putting in accounts, which is great, right? We commend you for that. But you've never sat down and thought about where that savings is going, right? Like Hans mentioned, a lot of it is in the 401k and the IRA. And that's just, that's where most of people's savings are. And so what we want to do today is really walk through the different types of accounts there are, talk about the advantages, the disadvantages of each, because really it needs to be a mix of the above. And it's as a result of the financial planning, how we figure that out. But at the end of the day, you need to think through where the savings is. And furthermore, if you have a child or something, because most of our clients, they've already had their savings and we're repositioning stuff. And sometimes it's costly to do it. There's tax implications. There's things like that. It's almost better to start younger, because then you can start with the end in mind and get it where it needs to go from the front end. That's not really what today's video is, but if you have kids, I want you thinking through that. And so let me bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board, and we'll get back to that and go through that in a second. And then we have just sort of a cleaner version of the board. If you really want to study this a little bit more closely, print this out. They're all sort of lined up nice and neatly for you. So again, you can find these at the show note here. So I'll turn it back to Hans. We'll get going sort of through the board and sort of go through each sort of type of account there is and talk about sort of where they shine and where some of the shortfalls of each type of account.
Okay, cash is great. Everybody needs a certain amount of cash. And, we talk about just a reserve, 6 months of income for where you're working and in case you lose your job. You need a certain amount of cash. And a lot of people, the advantage to this is really the liquidity. I mean, is that you can go get cash when you need it. You don't pay surrender penalties. It's not in a CD, so you don't have an interest rate penalty. You can just go get it. And it also, a big advantage is you've got minimal risk, especially if it's in a bank. You got insurance against that. I mean, the downside to it is you're getting a very low return. And so people that have large amounts of cash that come into us, I mean, first thing we want to do is, did this happen all of a sudden? Did you sell something, or did you leave the market, or is this money you've just been accumulating and you just like having in your back pocket a large amount of cash? And if that's where you want to be and that's where you end up, we honor that. I mean, but people that have a large amount of cash, a lot of times we're able to talk them into maybe cutting it in half or cutting it down to like 40% of that amount and investing or doing something to improve the rate of return. So to you, Tom.
Yeah, I mean, I think the cash is, like Hans mentioned, it's important that you have some level of that, right? For emergencies, for liquidity, sort of that emergency fund needs to be available. It doesn't need to be at risk. And so I think there is an appropriate amount of cash that everyone should have. Everyone's number is a little bit different, right? It's very dependent upon your situation, but there is cash that needed. But the risk of having too much cash is you're giving up some potential return. And where that really becomes a problem, if we start thinking about inflation and how things get more expensive over time, if we have money sitting in a bank account that's not earning enough to keep up with inflation, even though it's safe, you're losing purchasing power, right? Over time, that cash won't be able to buy the same amount of stuff that it could today. And so you need to have money outside of cash in different investments, in some of these other types of accounts, to really get that rate of return. And again, it's a mix, right? There's an appropriate amount. And a lot of times people that have a lot of cash are typically fearful of the market, right? Maybe they've been through a downturn. They don't want to go through that again. They might be entering into retirement. I mean, there's all sorts of reasons we get there. But there's other ways that we can get to things that are safer, that are serving a better purpose as part of the larger plan, and meet your needs better than just holding in cash, kind of hoarding that there. So again, we're not anti-cash. We're just against having too much cash as part of your overall asset allocation.
Okay, this second category, 401k IRAs. Okay, this is an area that most people coming to us, most of their financial net worth, or a lot of it, a high percentage, 70, 80, 90, some of them 95% of it is in this pre-tax IRA 401k. And it really, when you go into the advantages, the tax advantaged accumulation. I mean, if it wasn't for the tax advantages, that money probably wouldn't be there. People have developed this over a long period of time. So I don't want to start talking bad about IRAs, because people that come into us have a large amount of wealth that's sitting there, and it wouldn't be there if it wasn't for that tax advantage or that plus. The downside of a 401k IRA is anytime you take money out of there, you got to pay ordinary income taxes on all of it, all that you take out. So you look at that, and if it's your savings account, if you've looked at it that way, your whole life is your wealth account. If you want to take a large amount out of there to make some major purchase, you're going to have to pay a whole bunch of taxes. You're going to have to take even more out to pay the taxes. So that's the disadvantage, is that the money's really tied up in there. And when we get people to retirement, now they got to start thinking about, I got to start pulling money out of here. And if you don't start it right when you retire, the government's going to make you start it through RMDs at 73 and beyond. So I want to push it to Tom.
Yeah, I mean, I think there's a lot of reasons that a lot of people's savings are in these accounts. One is primarily is just the ease, right? It's pretty. You put it up, you set it up with your employer. If you work for a company that offers a match, you're putting money in there. You're getting the match from the company, which is great. We recommend everyone take advantage of that. But it's sort of just out of mind, out of sight, right? I mean, out of sight, out of mind. That you're not having to think about it. You're not having to make a step. And so what ends up happening is people set it up. They don't think about it. It's automated. It's going in every month out of every paycheck. And then it's, you look at compounding interest and getting to the rate of return, right? Depending on the investments you held inside that account, you would have a much higher rate of return over time than you would in the cash. And it just, you have the time of compound interest. And so that's why there's a lot of value in there. A lot of money gets in there. Again, the problem is just on the way out, right? It's like we sit it there. This is where most people are. They haven't really thought about it. They're getting a tax deduction on the way in. So it's actually reducing their taxable income in the year they're putting it in, which that always feels nice, right? Not paying more taxes now. The problem is there will be at some point you do have to pay taxes, right? At some point this money is getting taxed, and most people have not thought through what that looks like on the back end. And so that's where it's better to think about that as early as you can. Unfortunately, a lot of the people we're meeting are sort of at that retirement age, so we're having to reposition some of this, maybe into some Roth accounts and doing Roth conversions and those type of things. Another downside of this is really on the inheritance. We don't necessarily have it on the board here, but a little bit sort of in some of these items. But when you leave this money to the next generation, to your kids, to grandkids potentially, now they have a lot of restrictions around how they have to withdraw that money. It's got to be emptied with over a 10-year period of time, which is less favorable, and that could push them into really high tax brackets. You spent all these years deferring all these taxes, which is great, until it gets to that point, and now they have to pull it out. So it's really not a great account to leave as an inheritance. But that's what most people do, right? Most people typically don't need all of it to live off of if you've done a good job saving. And so you don't need it to live off of. You leave it in there. You just take the minimum out when you get there because you don't want to pay more taxes, but you're just leaving up this tax bomb to go to sort of the next generation. One of the other benefits, and again, some of these other accounts have this too, is there's some lawsuit protection, right? There's creditor protection on these type of accounts. So when we have MDs or doctors, that's something that we always want to be mindful of, right? Because they have a higher likelihood of malpractice suits or things like that. So there's some benefits from a protection standpoint there that like cash, for example, would not have.
So the Roth 401k and the Roth IRA just simply takes the advantages of the 401k and the IRA and enhances them because it's got tax advantage withdrawal and it's got tax advantage accumulation. So when you do a Roth conversion, which is just moving money from here to here, you got to pay the taxes. And then that's the downside. That's the negative. But the positive is all the accumulation from here on is tax-free, not tax deferred. So you are not going to pay taxes on any more growth beyond the point of the Roth conversion. And then when you pass the money on to your kids, if that's where it ends up, they're not going to pay any taxes either. So it's nice when people have an appropriate mix of the two. In a lot of our financial plans, we're going to make a recommendation that people do this year by year by year, because you don't want to do too much all at once. It's going to drive you into a very high tax bracket. And then there's another point of that is it's nice when we can pay the income taxes out of taxable investments or out of cash, leaving the most amount in the IRA, but then the Roth IRA. So the disadvantages to the Roth, like I said, is you got to pay the taxes, all up front, or just at the time of the conversion, as opposed to waiting and pushing down the road. Tom?
Yeah, I mean, I think I would agree with what you just said. Is the biggest disadvantage of the Roth account is you have to pay the taxes now to get the money in, so you don't get a tax deduction now, but the growth on that account and the future withdrawals from that account are tax free. Some of the other disadvantages comes to liquidity. There's some rules around accessing the money inside the Roth. A big one is you have to be over 59 and a half. There's some exceptions, right? The principal amount you can access earlier to that point. The gains, there's some rules around that. So there's rules. This video isn't really about getting into all that on the Roth specifically, but just know that if you're just establishing a Roth, you need to at least maybe look through, and we have some other videos that we talk about this, to really go through what those rules are. Make sure you're not messing that up at all. But at the end of the day, right, it's a great type of account. It grows tax-free. It gets passed on tax-free to the next generation. You can leave it to your spouses. It doesn't have RMD, so you're not forced to take money out if you don't need it. So there's a lot of real benefits of that. And a lot of what we're doing with our clients is we're taking money from the traditional IRA, again, where a lot of their savings are, and we're slowly moving it into the Roth, again, solving for tax brackets, solving for IRMA issues. It needs to be part of a larger plan, but slowly building up that Roth pot of money really as a tax planning strategy.
Okay, so taxable investments. And this is just money that you have invested that is not in an IRA or a Roth or any tax favored account. It's in a brokerage account or it's in a savings account. And you're paying taxes. So, I mean, I'll go over the disadvantage first is you're paying taxes on any interest earnings or dividend payments right in the here and now. And just even if you're not spending that money. So in retirement, a lot of times we're going to want to actually take that money out that you're paying taxes on or the net amount and live off of it or contribute it to your income. So that if we're paying taxes on something coming in, we want to have the net remainder into your income. So the advantage of it is you can sell the stuff and you don't have to pay taxes on all of it. It's just the capital gain, and those rates are at a lower rate. So this money is more liquid than the stuff where you got to pay taxes or the stuff where there's a surrender penalty. It has a liquidity features, but the big downside is you're paying taxes as you go along, whether you're using the money or not. So I want to pass it to Tom.
Yeah, I mean, I think another benefit of this account is on the funding side of it. Like when you're still working, is there are no limitations on how much you can put in this type of account, right? With 401ks, IRAs, Roth 401ks, Roth IRAs, all the numbers are different, but there are limits on how much can go into those accounts. On the taxable brokerage account or taxable investments, there is no limit. So you have a lot of extra money. It's a very easy way to do that. If you're in retirement, you can't add new money into the Roth or the 401k because you don't have any income to do so. But if you have a bunch of cash, we could reposition that into sort of taxable investments or something like that without any restrictions there. So that's a real big benefit. And then again, another benefit is upon death, at least under current laws, is they get a step up in basis. So the investments, say you bought something, it's grown, it's doubled in value. You never sold it while you were alive, and then you pass away and you leave it to a spouse, the kids, or whoever the beneficiary in the account is. It gets a step up in basis, so they could sell it upon your death, and that growth is never taxed. And so it's a really great way to build wealth to pass things on. You're giving up some of the tax benefits of like the IRA or the Roth, right? I mean, you are paying taxes on the growth if you sell it during your life, where you wouldn't in those other types of accounts. So there's disadvantages there as well. It also doesn't have the same creditor protection that IRAs and 401ks do. But it's a very useful type of account that I think gets underutilized. We see a lot of people have money, should have dedicated some of their savings to this type of account as well.
So wealth accumulation life insurance. How do we use this? And by that, I'm talking about cash value life insurance. And so we can start with the downside is it's not liquid. It's not money you're going to stick in there like cash or in these taxable, stick it in there and then pull it out next year. It's a long-term deal. But why do people do it? Well, first of all, it's a bit of a forced savings because it has a premium. So when we're planning and people buy this, they're committing to put $10,000 a year into this for 10 years, just as an example. And they're going to be inclined to put that $10,000 away and separate it out and pull it out of their taxable investments or their cash and just pay the premium, or pull it out of their IRA, pay the taxes, and pay the $10,000 into the premium. This money accumulates on a tax advantage basis. I mean, you're not going to be paying any taxes as it grows and grows and grows. And then you can access the money at a very low interest rate, or if you wait long enough, at a zero interest rate, where, at a net zero interest rate, where I've done that with some stuff personally, where I'm paid in for a number of years, and then I access the money through a loan, tax-free, and then I paid it back. I did that to start my business years ago. And this we're not going to get into a whole thing on the life insurance, but it's got the negative check mark under the short-term liquidity. It also, you can have some multipliers in there for long-term care, where in other words, you could access your death benefit. It has a feature, which is the main feature of life insurance, is if you just leave it there until you die, it's going to transfer to the beneficiary, all tax-free, the life insurance benefit. So Tom?
Yeah, I think it can be very useful as part of, again, a larger plan. We wouldn't recommend anyone just put all of their savings in any one of these accounts, right? But the life insurance is a way to have some growth on there. Again, we're talking about cash value life insurance, not necessarily term policies for this show. Um, Again, depending on the type of policy, there could be little risk to that. And then the death benefit is tax free, right? And then you can access it yourself. There's a lot of flexibility there. What you can't do, and again, what the negative is like if you put money in there, typically you're not going to go take it right back out, right? That's not the design of that. If we knew that was going to be the case, we wouldn't recommend that as part of the plan. But it can be very useful as a way to build some wealth, to have some tax benefits. The growth potentially be tax free. Definitely would be tax free to the kids, and if you pull it out properly, it would be tax free to you. It's a very useful tool as part of the sort of overall plan to have some money set aside for this type of account.
So immediate and deferred annuities we use those a lot in our practice. And again, we don't stick all your money in an annuity, and we don't use too many annuities for just pure accumulation. We're going to use the Roth IRA, the taxable investments for accumulation. Annuities are designed to pay you a check every month and to guarantee that you're going to get that check as long as you're alive, or as long as you and your spouse are alive. The one who lives the longest gets the check for the entire of their lifetime. It mitigates longevity risk. So, but they certainly have their disadvantages. I mean, number one is liquidity. I mean, we don't put any money in an annuity unless the plan is to just leave it there. Okay. Perhaps for several years before we even take anything out of it. But once we start taking money out of it, then it's going to produce an income like your Social Security check that isn't going to stop till you die. So that's a tool that we'll use in the overall plan. And we can take IRA money and directly transfer it into an IRA annuity. So you don't pay taxes when the transfer is made. You're going to start paying taxes when you start pulling the money out. And we have those types of things where we can even do the Roth conversion inside of the annuity. So don't want to get into a lot of detailed thing. And again, the negative is the liquidity, that you're tying that money up. So it needs to be part of an overall plan. Tom?
Yeah, I mean, I agree, right? I mean, how we use this a lot in our practice is building out an income plan, right? You have Social Security, you need more income above and beyond Social Security. This is a way to guarantee it, have some safety around that, and not have to worry about the market fluctuations. And again, you wouldn't want to put all your money in this, right? You'd want to have other money outside of this, and some cash and some more traditional investments, whether that's in a taxable account or IRA or 401k or Roth account. But as part of an income plan, these can be very useful, provide some safety of principal, provide some guarantees there that other accounts can't. But again, the downside is just liquidity, right? You wouldn't put money there that we thought you might need down the road, or in a short period of time, because there's penalties to access it. It reduces the income that we designed to pull it for. So it needs to be part of a larger plan, but they can be very useful when positioned properly as part of your overall portfolio.
Yeah, this checkbox down here on the bottom is some of the annuities that we put people in have these doubler benefits for long-term care. So, and there's very little, if zero underwriting. So people that have chronic illnesses already that are anticipating long-term care, they can set up an income plan where they're going to get a monthly check starting at some point, on both of them that covers both of them. And then if either one of them needs long-term care, there's a doubler in there where the check will double for up to 5 years. So I don't want to get into the details of that. We have other videos, but I want to let you know that that just comes along for the ride. There's also in annuities, there's some level of protection from lawsuits, where there's a barrier there because these are for retirement. So again, that's another video, another plan, but we're going through all the advantages and disadvantages. The last one is we don't typically take a retiree and put them in real estate. Okay. I mean, I won't say that we've never done it, but it's not something that we typically recommend adding. But we have a lot of people that come to us who already own real estate that's not their primary home, and it's an income generating for them, or they want to get into it, or they inherit it, or there's just all kinds of things that people come to us with this wish. And so we wanted to include it in here. And I guess the biggest disadvantage to income producing real estate is its lack of liquidity. I mean, and then there's the other one for people that are aging, is that it takes work, and it takes, you need to be involved, even if you put it to a leasing agent and, a property manager and that kind of thing. So sometimes people come to us and they're into real estate and they've got some pieces and they're wanting to liquidate them, because just for that purpose, is they don't really see themselves being able to take advantage of it and finishing their life that way. So there's lots of tax implications and income. We just wanted to go over that, is the lack of liquidity and the fact that it takes messing around and it takes the ability to do that. The positives, there's a lot of tax advantages. There's a lot of safety, in real estate, that it's generally over time has gone up. Rents are going to increase. So, Tom?
I mean, I think liquidity is sort of the biggest downside, right? You can't go get money out of it very easily. I mean, I guess you could refinance it and do things like that, but there's costs there and higher interest rates that you're paying in doing so. It can accumulate quite a lot, right? Historically, real estate has been a great wealth accumulator. Will that be the same in the future? I mean, time will tell. We don't know. But there's a lot of tax benefits, right? You can take depreciation on the tax return. And I don't want to get into too much details there, but there's a lot of tax benefits around that. But to Hans's point, it takes work, right? A lot of times people come in, they maybe have seen videos on the internet or something talking about how this real estate, it's passive investments. You get this income, you don't have to worry about it too much. The thing that all those videos and people miss is that it takes work, right? It's not something you can set up and don't think about, right? You have to deal with tenants, which are real people with real problems that can do real damage to the home or have issues there. You got to deal with things happening to the house, storms. I mean, there's stuff that has to go on that you have to manage, even if you hire a property manager. So it's not all that it's cracked up to be a lot of times, but it can be a great way if you're interested to build some wealth and have some diversification, have things that aren't tied to the stock market, for example. But again, it's just, you need to be willing to put in the work to do that. And if you're doing that, great. And I think it could be incorporated as part of a larger plan.
So in the terms of comprehensive financial planning, we talked about Social Security today. That's your base income. I mean, the title of this thing is income, and just every senior, or most every senior, has a Social Security check, and couples have two of them. We talked a little bit about long-term care, but you talk about a sudden need for a large income that could happen to you with long-term care. And some of these investments have, specifically the annuities and the life insurance, have some multipliers in there that can give you some additional income right when long-term care happens. We've talked a lot about 401ks and IRAs and decumulating them or distributing them into yourself, and you need a plan to do that. The whole show's been about income. We talked about estate planning in terms of that a pre-tax IRA is not a very good asset to leave to the next generation. It's better that you use that during your lifetime or convert it to a Roth. That's a great asset to give to the next generation. And then taxes and income taxes have been a big part of that. I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.